Hello, everybody, and welcome back to the M3 Market Update. My name is Melody Wright, and I do this show to try to give you context about the residential and commercial real estate markets against the backdrop of the world economy. So, welcome back to the show. I hope that everyone had a wonderful holiday. I know you probably didn't get a lot of rest because the holidays tend to be very busy. I certainly did not, and I'm a little under the weather, as you can tell, which I caught from a little rugrat niece. Um, but I think that we all should try to get some rest this weekend because I think it's going to be a very interesting year in 24. We've already had some interesting things happen in the market. Essentially, the stock market yesterday, very interesting in those declines, as well as the 10-year treasury kind of taking its way back up again. And I don't think there were a lot of people expecting that. I think a lot of people think the trajectory is down, and that may be the case, but we saw some dollar strength, which I haven't yet to get I haven't seen quite a good explanation, but it could have to do with some of these world events that are going on. We don't know, and I think that is the danger is that anything can happen to really turn some of these trajectories around. So we have to pay close attention, and that's why I really do try to do this show for you guys. So, welcome back. Let's get into the data first. The show will probably just be a little bit shorter just because I am under the weather and having a little bit of hard time talking. But the first thing that I want to talk about is the construction spending data we got yesterday. And so, if you read mainstream headlines, most people, and even some good newsletters that I love, were talking about the fact that, it was up, and some said maybe kind of flattish, but they were talking about the seasonally adjusted numbers. And so, what is a seasonal adjustment? Essentially, this is a tool that economists use to try to smooth things out for those seasonal patterns. And so, I can totally understand that. Makes sense. Because, for instance, when I was looking at those listings for sale, looking back to 2017, you could see a huge drop always from November to December. And, what you're trying to look for in data is, what is against the trend. And so, that's why economists use seasonal adjustments. But I think sometimes, especially during critical inflection points, it can create a confusing picture. And in my opinion, I think you have to look at both. But I personally would put more credence onto those unadjusted numbers. And what we saw in construction spending is actually month over month, it was down by 5.67% for all of construction, and down 4.75% for residential construction month over month. And so very different from the headline you got out there. Additionally, new single family construction was down 15% year over year and down around 0.4% month over month. So 15% is pretty significant. And I can tell you, one thing that I know for certain after all of my travels on the road, seeing all those construction trucks, bulldozers, the people supporting them, the people with the porta potties, the people that bring the construction workers lunch, the food trucks. When all of this ceases or even slows, it is going to have a massive impact on the economy. So it's something that we want to really see the minute that it happens. And I think that we are starting to see it slow. And that's going to have interesting impacts. The other metric I want to talk to you about is one I learned about from Danielle DiMartino Booth. She does a daily newsletter for people like you and me, not institutional investors. I highly recommend you check it out or sign up for it. But she tracks something called the Architectural Billings Index, and I knew because I was sick that would be hard to say, was the ABI, and that is actually really down, and it has been down for, I believe, like 9 months, and it's sitting at 44.8. And what is this? So basically this is, how much are these architectural firms billing? And so, of course, when there's new projects, they're going to be billing quite a bit, and they're going to have a lot of work. But it's now, contracting. And get this, in Q1 of 2001, it was basically around 45.2. And then Q1 of 2008, it was at 45.1. And so we're actually lower than either of those two times. meaning, there's not a lot of work out there or new work for architectural firms, and that's important. Okay, the next piece of data I want to talk about is something I talked about before we all went on vacation, and that was applications. MB Mortgage Bankers Association tracks applications every week, and they were down. And I said, 1 week does not a trend make, and that's absolutely true. But believe it or not, they just came out today and they're down again. And this is another one where they do the seasonal adjusted versus the unadjusted. And seasonal adjusted, they were down 9.8% from 2 weeks ago. For basically the unadjusted, this is going to freak you out a little bit. They were down 38% from 2 weeks ago. And so these are applications for a mortgage. Guys, and so listen, these little rate declines, they will have an impact, but I think everyone thought this was just going to take off, that everybody was going to be, applying for a mortgage, getting a home. But this isn't quite the season. And according to this survey and the information they give, they say that applications were up by 15% from 2 weeks ago, but they don't tell you if that was a seasonal adjusted number or not. I don't know. But, that's a pretty significant decrease down. And it seems that rates will have to go a little bit lower to get the kind of activity that I think people were expecting. And, with the 10-year actually in the past 2 days, sticking where it is, I think that's also surprising to folks, as they thought that the trajectory was and the momentum was just down. But we seem to be sitting right here. So it'll be interesting. And this is why I do this show, so we can track this stuff and get a real pulse on what's happening out there versus just the narrative machine. And the final thing I want to talk about, and this is really interesting, is I tweeted this out yesterday in the newsletter that Fannie Mae does for its appraisers. There was a caution in there about properly recording the concessions. And what Fannie Mae found is that in 58% of over 7.6 million comparables that they looked at, and what's a comparable? So what happens when you do an appraisal? What you're doing is you're looking around, at other homes that have sold recently that are similar to your home, and trying to figure out what is that home worth. And of course, it is all about, comparing that to other homes that sold. Well, what's happening is essentially people that are giving concessions, either, that's some sort of money in or a repair, or in the new build situation, they're buying down your rate. And that's also happening in just your existing market as well. The lenders are doing that. And so essentially they're giving something to you so that you'll buy that property. Well, appraisers are not adjusting the price for that. And so let's say that you got $30,000 worth of concessions. Essentially, you had a $500,000 home. Those concessions need to be considered. For me, that'd be that your net price on that home was $430,000. While in 58% of transactions, that's not happening. And so I want everyone to start to think about that and how that might be impacting or inflating sales price, I should say, inflating sales price. And so one article I'll post in the show notes, and I talk about a lot, is written by Michael Pettis, called The Bezel. And the idea is that often in our economy, there are these places where things kind of get inflated and makes everyone feel like something is of higher value, or that, someone's richer. Like if you think about your Zestimate and you think, oh yeah, I've got like 200,000 in equity. But in reality, if you tried to go and sell it right now, based on what I just told you, it's likely your property's not actually worth that much. Similar to, if you guys remember the story about the silver, that a certain bank thought they had a whole bunch of silver. It was valued on their books. And then, when they went to go do their yearly audit or whatever, they realized that silver wasn't there anymore, that it had been stolen. But for a good, let's say, a year, I don't know, I can't remember the exact time. They thought they had X amount of an asset that they didn't really have. And that's what the bezel is this idea of that you have you this inflated idea of what you own, your assets versus what's the reality because of fraud and things like that in the system. And do you want to call what the appraisers are doing fraud? I think that might be a little harsh, but they're certainly not following the rules. And it's inflating those appraisals, inflating the prices that people are paying. Now, we kind of ended the year with the bulls celebrating the case Shiller, these lagged indices showing that home prices were up. What I would say is that, again, these are lagged indices. All of that celebration should not, it should be taken with a grain of salt. We will track this information and figure out exactly what's going on, but just based on the cities that I track, certain key cities, we are already starting to see price declines. And I'll have my monthly summary out hopefully by the end of the week so that everybody can see those cities, see what's happening. Because at the same time that your sales are actually decreasing your volume, so are your prices. And that is very interesting. Okay, so a lot of data already at the beginning of the year kind of telling us that we are going to have to stay frosty because, this is where I think we come out of the messy, muddy middle. And I said it last week, we kind of, or a couple weeks ago, we land on the beach. And this is when we have to be looking around and paying close attention because things are going to change very quickly in some of these local markets, especially Florida. What I am seeing in Fort Lauderdale, Fort Myers, Lakewood Ranch tells me that everybody should be watching Florida. And, a lot of people give me some hate on that. But here's the thing, that property tax and insurance situation is dire, as well as, kind of the fact that we don't understand the inventory that's out there. I mean, people today still I've seen this all over the country, and in Florida, it's actually it's just unprecedented. Take somewhere like Lakewood Ranch, who has 60,000 homes right now. That doesn't even count what's in construction, and there's like 1,800 jobs. Sure, maybe they're commuting, but if you saw that commute, you wouldn't be doing it. So let's see. And there's just so many more coming online. There are just so, if you haven't read my Substack called Go Back to Sleep, I'll post that again in the show notes. There's some great video footage there of one of 21 sites. And it was, if you went to the other 20, it was just more of the same. And I think you guys will be shocked when you see how much is under construction. And we know, and this has been confirmed by my own eyes, but also in what people tell me, is that the builders they never list all of the new homes coming online. And so maybe they put one on the listing site. And I'm seeing right now that it looks like they're pulling them off of realtor.com. I took some addresses, I did some verification. They're on Zillow, but not Realtor. We know that the source the Fed uses for inventory is realtor.com. And so even today, I'm asking everybody why they would not, the builders wouldn't syndicate those to realtor.com and trying to, get some good reasons beside the one that I think it is. People say cost, but if you guys have seen the marketing from the builders right now, they're blasting everybody. They're doing everything they can. It seems unlikely to me that this is about a cost of listing it on Realtor. And so, but of course, we shall see and we will track it and we will see what happens. Okay, so again, I'll do this a little fast just because it's a little hard to talk. But what I've noticed about inventory, like I said, is definitely came down week over week for most of my cities. But I think what's even more fascinating are the cities that it did not. And in fact, we had some minimal increases. So, top cities with largest percent increase in inventory week over week, 1217 to 1224. Rosemary Beach was up there at 3.70%. San Antonio at 2.37%, Tupelo at 0.30%, Boca Raton at 0.19%, and Fort Myers at 0.13%. Now, why is this important? I just kind of said from November to December, we usually see inventory decrease by 10%, but we're seeing in Florida and in Mississippi that we're seeing these very, small increases, but it's telling you they're going against the trend. And I think that that is because the stress is starting in those markets for sure. Okay, top cities with largest percent increase in inventory compared to the 22-week average. And this is again 12/17 to 12/24, the week before Christmas. Hoboken again up at 47.53%. Bakersfield, California at 14.96%. Palm Springs, California at 14.13%. Fort Lauderdale at 11.31%. Fort Myers at 10.05%, West Palm Beach, Florida at 6.37%, Pembroke Pines at 6.17%, Johnson City, Tennessee at 5.89%, Brattleboro at 5.63%, and Miami at 4.64%. And guys, I know you can't see it on the screen, getting closer to a time when I can take the time to share video, etc. But I have pasted these in the show notes so you can check them out there. And now, Topsy's large percent increase in inventory from start. And so, starting next week in my monthly summary for many of these cities, um, I think I started with around 25 cities. I can't remember exactly. I'm going to have year over year information, and this is going to be very interesting. But Topsy's largest percent increase in inventory since January of 2023. Hoboken at 75.34%, Bakersfield up at 64.27%, San Ramon at 56.67%, Galveston, Texas at 42.68%, Fort Myers at 37.64%, Coeur d'Alene at 33.94%, Dallas at 27.57%, Denver at 19.83%. And for those of you that don't normally read my Substack, I would recommend reading this week's as I do a deep dive on Denver. And I just think these numbers, based on what I saw in Denver, are going to start to increase, quite a bit. Denver is one big new build site, and the affordability there is just, it's crushing. The average median listing price in the US is around 420,000. In Denver, it's around 625,000. And the average median household income is 86,000 in Denver. I lived out there for 4 years, and I can tell you every single person, and I left in 2019, would talk about the unaffordability because wages had just not kept up, and people were working 2 jobs. They were house hacking before it had a cute name, which is they were getting a roommate. Their partner had another job. I mean, every single person you met was, had to supplement their income somehow. And the people that I managed all were under financial distress. I say this in the Substack, but it was one of the first places that I really encountered the labor shortage. But in reality, what it was is my company, my servicing company, was not paying decent enough wages to actually compete with some of the pay increases in the service jobs. And so people would rather go, wait tables and have that flexibility versus working a corporate job. Denver is very stressed, and it's going to be, and they've had negative demographic from 20 to 22. And so there is actual population decrease in Denver. So I think that market is about to come under some significant stress. And then lastly, number 10, Austin knocked out San Fran at 18.10% inventory increases since start. I hope to do a little more diving into San Fran because although their listings for sale have definitely decreased, their listings for rent have kind of increased, but something seems to be happening there, and I hope to spend some time over the next couple weeks figuring out what's going on. Okay, listings for rent. So you guys may have remembered that they were still kind of staying up a little bit. They finally decreased. I don't have data to compare this to, if this is a seasonal thing or not. My gut says it is. I cannot believe that with all the multifamily that we see coming online, that this decrease will persist. So I absolutely believe we'll start to see increases as we get further into, kind of February, March. But top cities with highest percent increase, so these are the ones where you did see an overall increase in single family rental listings. Portsmouth, New Hampshire up at 32%, Houston at 6.93%, San Diego at 6.73%, Pittsburgh at 6.67%, and Rochester at 6.02%. Excuse me, guys. Okay. Top cities with the highest percent increase of single family rental listings to the 22-week average. Portsmouth takes this top spot at 32.29%, Cape May at 30.43%, Knoxville at 27.25%. And I didn't get a chance to do some touring, but did spend a little time in Knoxville and kind of looking around. And I do think that although not as crazy as some places across the country, Knoxville definitely went a little bananas with building, especially building multifamily, building these new homes. I know that they had a student housing shortage, and I think we're going to see this in a lot of different cities, seeing it out in California where you had colleges. People just don't look at this all in totality. And I think that you had student housing being built at the same time you had multifamily being built at the same time these new builds, because of this perceived shortage, and nobody was looking next to them and saying, hey, do we, what's all, how much housing are we going to have when all is said and done? And I think that's what's happening in Knoxville based on stories I've heard. I have a nephew who is at college at University of Tennessee in Knoxville. Okay, Dallas at 26.15%, Houston at 22.06%. So, I think, and I think this will probably be the story of 2024, is we are going to see distress in these southern markets as more and more inventory comes online. And, I saw a really cool, and I'll put it in the show notes, a very interesting update from kind of a multifamily operator, or kind of he helps with lending and things of that nature, brokers, those types of deals in the Texas area. And I'll put it in the show notes, but there are a ton of these multifamily properties that are actually in foreclosure or about to, likely end up in foreclosure because they just can't get the financing they need. So I think, the story of 24, and I'll talk more about it probably next week when I do my look forward, it's going to be around commercial and especially around multifamily. I think unless we see significant sort of rate declines in that 10-year, there are going to be a lot of people who are not going to be able to refinance. And I'll put that link in the notes below. Okay, and then for this week, just because I don't have short-term rental data, I'll have it next week. I wanted to add just a little bit more data, and that's the top cities with increases in foreclosure. Now, I've just started using Realty Track, so I don't have a good sense of why things may be decreasing, increasing. We know that the VA have gone on a foreclosure moratorium. I also know that often private investors will put holds on during the holidays and not foreclose. But I saw some significant decreases in foreclosure month over month. And so, I'm not, I want to do one more month to really see, did I misunderstand the data? I'm not sure. So I'm still working on that. But the cities where we did see increases, I think is notable. And so Sevierville increase of 25% month over month, Dallas at 19.57%. And Sevierville's in Tennessee. For those of you that don't know, it's a hotbed for Airbnb. Scottsdale, increase of 19.35%. Tupelo, increase of 16.67%. And San Antonio, increase of 7.65%. So these southern markets and the Sunbelt markets, inclusive of Arizona, again, I think this is probably going to be the story for 24. Okay, sorry that I raced through that, but you can probably tell I'm struggling to talk here. So I hope everyone had a wonderful holiday. I think that things are really about to get kind of crazy And I know that we felt like 2023 was crazy, but I just think that, everything that's going on is going to make for a very interesting year and very similar to last year when we all got it wrong. I think that a lot of people are probably coming in with a wrong idea about how this year is going to pan out. But we aren't going to have to guess because we're going to follow the data from, we're going to look at the lagged indices, we're going to look at the leading indices, we're going to look at seasonal versus non-seasonal. We're going to look at it week over week to really try and understand what's happening. So, I really appreciate everybody that joins each week. I really appreciate your support. Please leave a comment. My New Year's resolution is to become a lot more regimented about doing these, as well as responding to comments. And so if you want to get in touch with me, the best way is probably on X Twitter at M3_Melody. You can at me, N3 Melody Substack, or leave a comment here. You can find me on LinkedIn, Melody Wright, but I'm way behind over there. So you'll probably get to me a lot faster on the other three mediums. But thanks again, guys. 2023 was just a crazy year for me, but ultimately a fantastic one, largely due to your support and all the encouragement that you've given me to come out here and talk to you as many times as I can. I was going to say each week. That's the goal for next year. And you guys can hold me accountable. So thanks again. And I look forward to next time because I think the conversation is going to get more and more interesting. Have a great week, everyone, and I'll see you soon. Bye.